I describe indirect lending as a timeshare for credit unions, right? Sounds like a great idea when you get into it. Then once you're into it, you find out it's really expensive, but you have no way to leave.
I recently had the pleasure of interviewing Don Arkell, the owner of CU Lending Advice. CU Lending Advice specializes in helping credit unions drive organic growth by developing customized sales processes. In this next segment, Don and I discuss the pros and cons of direct versus indirect lending.
This is one of my big challenges with indirect lending, for instance.
Okay.
Is that I've been
I'm glad you're going there too. Glad you're going there. That's where we were going next. Actually, let me frame it a little bit for you. Direct lending versus indirect lending. Your general thoughts conceptually around building, and then also if you're going to do indirect lending, I would maybe want to get to some points and try to eliminate that fraud and some of the risks. And hear you talk about those things.
Certainly, right? I mean, we could go on for hours about this, and I typically do, but I'll kind of summarize it out for you. When it comes to indirect lending, in order to do less indirect lending as a percentage, you have to have a viable alternative, right? Indirect lending started as a transfer of overhead. That's how it began, right? I've been around long enough. I saw when indirect lending came in. The big challenges of indirect lending that we don't have as much anymore, but way back when it started, what burned a lot of credit unions was they abrogated their underwriting to a third party, right? Because credit unions aren't open on the 12 holidays we take off a year. We're not open on Saturdays. We're not open past 5 or 6 o'clock. And guess what? That's when members buy cars, right? And so the idea behind indirect lending was a transfer of overhead because we weren't available. We could not make decisions. We could not fund loans. Then it quickly, over time, it became a revenue source for the dealers, right? And where we were paying increasing flats in order to originate loans, where instead of a transfer of overhead, a way to serve our members or even gain new members, it became a profit center for the dealers. Right. So what I would tell you is that it's difficult not to be in the indirect lending game if you don't have a viable alternative. Right. And that's a viable alternative from the origination side and the funding side. And so, the pros of indirect lending. Right. Let's just say what they are. I mean, let's give the devil the due for the minute. And that is that they're available. Right. It's availability. That's where the cars are. 87% of all purchase decisions are made at the dealership. We have to compete and fight for their business. So that's where the cars are. Right. And the finance manager, right, has a motivation that's maybe different than our motivation. So those are some pros for it. I understand the pros. What are the cons? Well, the cons are they're expensive to book. Right. I went to public school, Anson, right? And if we're doing a 3% auto loan and we're paying the dealer 2%, and we're paying, we're only approving 25% of the apps that come in, but we're paying credit on every one of those. We're paying system costs on every one of those. And then we're only funding maybe 50% of that. We're dedicating all the FTE and staff time to do that. By the way, we're not selling our gap. We're not selling our warranty. We're not selling our credit disability. We have, if you look across the industry, indirect loans perform worse than direct loans.
Correct.
I describe indirect lending as a timeshare for credit unions, right? Sounds like a great idea when you get into it. Then once you're into it, you find out it's really expensive, but you have no way to leave. Right. And I'm not interested in blowing up your indirect program, but it's almost as if credit unions have forgotten how to do car loans. Right. I have several credit unions, large ones, big credit unions that are 100% direct. You don't have to do as many direct auto loans in order to make the same amount of money as you do on indirect loans. I've got a large client in the Midwest that's done the analysis at his credit union, and because they have a credit appetite in that space that's only for top tier credit, they're making $1.50 a loan per month. That's what they're making. And it depends on what your motivation is, right? If your board's motivation is, hey, we want to grow members, right? It is a great way to do that, right? We have near members and sincere members. right?
Okay.
And to your point, when they go into the credit union or go into the dealership, they didn't go there to start a banking relationship. They went there to buy a car. And oftentimes they don't even know who you are, right? So I have some very successful credit unions in the indirect space who have a dedicated effort to actually reach out and ask that member for more business. And I've got credit unions that generate millions of dollars of loans on the cross sale after the sale. The average in our industry of picking up an additional service from an indirect member without any effort is 5%. Okay. 5% of your members get another service. I've got credit unions that have that number in the 20%, but guess what? It comes with effort. It comes with effort and adding an additional profitable service. I'm not talking about adding another sub savings account or something that's, or e-statements as a service. I'm talking about a revenue generation. So, you know, I've never, when it talks about fraud, Anson, I've never seen a movie where the car dealer is the hero. I've never seen that movie, right? And we deal in that space, and there's a lot of good dealers out there, right? I want to be clear. But what I'll also tell you from an underwriting perspective, and this is where AI can help us for sure, when it comes to the veracity of the application. Most of the decisions that are made in indirect lending are made with independent third-party records based solely on the credit report, for instance, because a lot of the application data that comes in, the dealer's in charge of all of it. And so sometimes, right, if we're being honest, we don't 100% believe everything that's on the application, but yet we still do it, right? And the performance is good enough, right? The numbers are good enough that we just say, okay, that's just kind of the nature of the business. There are some tools that exist to help you make better decisions in that space and also in the direct space as well. But you know, I've got credit unions with 50% loan to share ratios that are 100% direct, that are more profitable, have better ROAs and better net worth than credit unions that are running 85 in this environment, 85%. And you know, they're 70, 80% indirect. I mean, it just depends on how do we define success, right?
Well, that's the thing. That's the thing where what's sustainable for the overall organization and what's profitable in the near term for the management teams to get their bonuses. Two different things. And in my opinion, when I look at institutions, when you're building branches and building a physical footprint, it's communicating to me, from my perspective, that you have intentionality around growing membership in that space, as well as growing your direct lending apparatus. However, you're building this physical presence, or moreover, you're building your digital presence, yet at the same time, I'm seeing your indirect and participations go up. You're speaking from my perspective, you're speaking out of both sides of your mouth, in that you're hiring fishermen and building boats, but you're buying your fish from Sam.
Yeah, I would agree. You know, in my 30-year credit union career, you know, I've never seen a CEO or VP of lending get walked from the organization because they did too many good direct loans or too many good direct auto loans. But I've seen plenty of people walked where they've either inherited a bad indirect program or they were just hitting the easy yes button.